Welcome back. This video is a short detour. I want to talk about a few institutional aspects of the financial markets for background. You can usually find this sort of material on the internet. Wikipedia will have a lot more detail too. So this is just a very sketchy summary. This class is more about the concepts than about institutional details. Financial market institutions are always changing. They change every year. They change certainly every 10 years or 20 years. There's two kinds of brokers. There are retail brokers, which is the kind that most of you will be using. Things like Charles Schwab or Robinhood for that matter. And then there's prime brokers. So prime brokers are brokers that are for institutional large clients, and they don't do everything that the retail broker does. They do more of the bookkeeping and they arrange shorting, which I will describe in a moment, but they do not do the execution. The retail brokers will also execute trades for you most of the time. That's just the easiest way to do it. There's many different variants of orders. So you can ask for an order to be filled at whatever the market price is, or you can say a limit order. You can say, buy Tesla at a price no more or no less than $300 a share. There are fill or kill options where either the broker is able to buy you the whole amount or the whole order is void. Their orders can be good for a day, they can be good until canceled. There is many different variants. The broker I currently use has something that's sort of in the middle. It says mid order, where they try and execute not a market or a limit order, but something that is close to the mid price, which I personally like quite a lot. There's also exchanges and non-exchanges. It used to be a huge difference. So the New York Stock Exchange was this place where people met on a floor and there were market makers and they had papers and they were throwing this around and they wrote tickets, and this was how shares were traded. These days, virtually everything is traded on a computer. Now, these different kinds of computer systems are still somewhat different. For example, they can clear orders together in batches. So they may wait until they have so and so many $1 million of orders on the buy side and the sell side before they execute it. That's fairly rare. But what they might do is they might say, we only execute once a minute. So we don't do it continuous. Everything that comes through in this minute, we just collect, buys and sell orders, and then once a minute, we actually cross them appropriately. There's also various institutional exchanges which try to do the same thing. They try and match people that want to buy and they want to sell, but don't try and push this so hard so that they get better execution. Now, there are regulations, and the regulations are a hodgepodge of many different sources. So Congress has a whole variety of legislation. Some of it also delegated to the Securities Exchange Commission, which in turn delegated some of the regulation to exchanges. That is still a special role of things like the New York Stock Exchange. Now, if you are a broker at the New York Stock Exchange, it is your responsibility to always have a quote for 100 shares. You always have to be willing to stand by to buy or sell 100 shares. You do that at a bid-ask spread. So you say, I'm willing to buy it for 100 and I'm willing to sell it for $100.50. And you always have to have a standing order for 100 shares. In exchange for you willing to do this, and of course being a member of the exchange, you get to see the order book. That is, you get to see the limits that people have asked. I want to buy this stock when the stock falls to 99. I want to buy 1,000 shares of that. And they can see it on both sides, so that helps them put in this particular spread, the bid-ask spread, for executing. There's also a large segment of the things that are being traded that are funds. So they're no longer individual stocks. They are mutual funds that usually get traded overnight. And then there's exchange traded funds, which are just like stocks, and there's particular rules about how they can get bunched up and when they're going to issue new shares. all specific by the fund sponsor, they've become extremely popular. So most of the time when people want to buy something like an S&P 500 fund, they used to buy mutual funds. These days they buy exchange-traded funds. The differences between them are small. There are some advantages for exchange-traded funds, but they're really small. There's a big difference between open-end funds and closed-end funds. Open-end funds means that in principle for a mutual fund, you can go to the fund and you can say, okay, I've got 100 shares of your mutual funds. Here are my 100 shares. Give me in proportion everything that you hold in terms of the stocks that you hold. So that creates a limit. When the mutual fund share price is much lower than the weighted average of its holding, people can just buy up the mutual fund shares, hand them to the mutual funds, get the shares, sell the shares, and it becomes an arbitrage. And because there's no arbitrage in the real world, that basically says that the mutual fund share price has to be roughly the value of its underlying holdings. A closed-end fund does not allow that. Now, why would you have a closed-end fund and why would you buy a closed-end fund? Well, for example, say you're holding real estate. You can't simply say, give me one apartment of this apartment building here. So you can't easily parcel it up. And if you want to sell real estate, it's not instant either. So in those cases, very often you have closed-end funds because the underlying security is not that liquid and cannot be liquidated, sold, handed forward and backwards. That's why we have closed-end funds as well. And both exist in both trades. American depository receipts, what they do is they take shares of a foreign company and put that into a fund-like vehicle. They really hold only these particular shares of this particular company. So if, for example, you wanted to buy the German company Siemens, well, Siemens is not traded on the US stock exchange. It can't be traded because Siemens does not file US financial statements. So the SEC does not allow US investors to buy Siemens. But what they do allow is that somebody forms an ADR. The ADR buys a lot of Siemens shares, and then you can buy shares in the ADR. Now, not everything that is traded in the financial markets is regulated by the Securities Exchange Commission. The Securities Exchange Commission, the most interesting aspects relate to the Investment Company Act of 1940. So even though the SEC was founded in 1933, the regulations on the people that create funds and trade them and interact with the investors are really regulated under the 1940 Act. It's been amended a few times. It regulates what mutual funds and closed-end funds are allowed to do. Similarly, what investment trusts are able to do, what ETFs are allowed to do. There's many other less regulated funds. For example, there's hedge funds. Now, a hedge fund is limited in what it can do. It cannot have more than 100 investors, for example, and the investors have to be certified to be sophisticated because hedge funds usually do a lot riskier things. Same thing is often true with private equity funds and venture capital funds. ADRs are somewhat different. Trust funds are quite interesting. So trust funds are vehicles that are set up by rich parents on behalf of their no-good kids. The no-good kids often cannot be trusted to spend the money responsibly, so they put the money into a trust account and they only allow the kids to draw so much from this. But lo and behold, the parents die, and now there is a lawyer who can actually administer trust accounts. It shouldn't surprise you that the trust accounts aren't managed particularly well. They very often churn their clients' money like crazy. If it was my money, I would not trust them. Now, how do firms actually enter the public financial markets? The way they usually do this is through an initial public offerings, which is conducted by an underwriter. There's a new vehicle that has emerged over the last few years that's essentially a reverse merger. So what that is there's a company that basically owns almost nothing. It's just a shell, but it's a publicly traded shell. Now, if you, as a private company worth maybe $2 billion, merge with this particular company, then all of a sudden you have a publicly traded company that is worth $2 billion. So that is a very low-cost way in many cases to actually go public without having to do an IPO, which comes with very stringent regulations. An SEO is a seasoned equity offerings. That means shares that are offered after the IPO. How does money flow from the public financial markets back to the investors that have given it the money? The obvious one is, of course, dividends. Shares, many shares, not all shares, pay dividends. That goes to the investor. That money flows out of the shell and flows back into the investors. It's not that different with share repurchases. So sometimes companies go out, they buy their own shares back. Whenever they do this, they buy it from a retail investor. The retail investor gets the money from the firm. Thereby, money comes from the corporate shell back to the investors. And the final way that the money exits is through a delisting, which happens very often in financial distress. It can also happen in mergers and acquisitions. What are the execution costs in financial markets? Well, it used to be that every time you wanted to trade, you had to pay a fee, something like $10, regardless of how many shares you wanted to trade. Most of these have gone away in the era of Robinhood. Now, you still have a bid-ask spread that you have to pay that is typically very, very low. So it means that if you buy some shares and then sell them an instant later, you may buy the shares for $10.05, and if you sell them just an instant later, you may only get $10.04. But they are very, very low. Also, if you want to trade a large amount of shares, not only might it be, well, you buy it at $10.05, now you want to sell them again, but when you sell them, you can't sell them all for $10.04. There are some that you can sell for $10.04, some you can sell for $10.03. So you just have to move down the demand curve. And that means you don't get just the 1 cent, you also get a price impact. Now, the most interesting thing for us is shorting. And shorting is essentially the equivalent of having a negative investment weight. One way that you can think about this is you issue securities just like the firm. So if I short Tesla shares, what I basically do is I say, okay, the Tesla shares now trade for $200. Okay, give me $200. I give you a certificate that says I give you exactly the same payoffs as what the Tesla shares are going to pay off. In the real world, well, you might not be willing to do this. You could do that with Tesla itself. So you need a little bit of extra from me. What do you need extra from me? For one, you need me to put some collateral up that guarantees losses. So I can't simply say to you that, oh, sorry, I got your money, but I will never pay you back. So I've got to put up collateral, and that is costly, especially if you're a hedge fund. You want to do this with a large number of shares. You need to have enough collateral to stand behind your shorts. Then there's another thing that is required by the SEC. That's the only way that you can short in the United States. The way this works is if I want to short to you, what I basically need to do is I need to find shares from somebody else. I need to borrow the shares, and those are the shares that I sell to you. Now, I'm short. I don't own the shares. You have the physical shares, actually, and there's somebody else who lent me these shares. And the party that lent me the shares, I have to pay the party a little bit on the side, which usually can be something like 10 basis points a year. Now, who are these lenders? The lenders are typically the index funds. So they have everything. They have a little bit of everything. They're quite happy. As long as they know that I will make good on my promise, they still have the equivalent of the security. They just get the extra 10, 20 basis points extra. The arranger, my broker who arranged this, who found the index fund for me, also needs to be a little bit greased here. So that broker may take maybe 5 basis points. Both of them have a good business, and I'm able to short. Now, it also used to be impossible to short Bitcoin. Why? Because if I shorted Bitcoin and Bitcoin crashed from 100,000 to zero, I would make $100,000 profit if the other parties all satisfied their obligations. But really, if the cryptocurrency crashes, whoever proposed to arrange it, the broker, would have gone bankrupt right immediately as well. So until very, very recently, you could not short Bitcoin. However, just very, very recently, the Chicago Mercantile Exchange now has a contract that lists Bitcoin as well. So now you can actually short Bitcoin. That's it for this video, for Chapter 7, and for my arguably too quickie description of market institutions. In the next chapter, we start to discuss how to put together a good investment portfolio. See you soon. Bis bald.
Why was the stock trader electrocuted?
Why?
He shorted Tesla.
Emphasis on he. Didn't you do this too, Professor Welch?
Snitch.